Welcome everybody to Brookings, to this event. We have a really terrific lineup of panelists, and we're looking forward to our keynote speaker. We are particularly pleased that all of the original participants, because this event was snowed out, and I can't remember, it was January or February, but anyway, it was snowed out, and all of them agreed to return, which is really fantastic. I just want to emphasize that Brookings, which gets its funding from a variety of sources, prides itself on maintaining its independence, and I urge all the panelists to speak their minds without fear or favor. Today's topic is an important one. Improving the stability of the financial sector has been a top priority, appropriately so. But slow economic growth is also a huge concern. Real GDP in 2014 was just 8.1% above its 2007 level, an annual growth rate of only about 1.1%. There are several reasons why growth has been slow, notably the aging of the population and the workforce, but it must be a priority now to make sure the financial sector is working effectively to promote investment, innovation, and growth. So that is the task for today, to shed light on how the financial sector can promote both growth and stability. Let me turn now to introduce our keynote speaker, Dick Berner. Dick is now the director of the Office of Financial Research. Prior to that, he served as counselor to the Secretary of the Treasury with responsibility for standing up the OFR. Before joining the Treasury in April 2011, he was co-head of global economics at Morgan Stanley. He previously served as chief economist at Mellon Bank and a member of Mellon's senior management committee. He was director of the Washington, D.C. office of Wharton Econometrics for several years, and he worked on the research staff of the Federal Reserve Board in Washington. Dick is a very distinguished forecaster. He won forecasting awards from Blue Chip, the Wall Street Journal, Market News, National Association of Business Economists, and was awarded the 2007 William Butler Award for Excellence in Business Economics. So it was great pleasure that I'd like to welcome Dick Berner as our keynote speaker. Welcome, Dick.
Good morning. It is a pleasure for me to be here, and I want to thank Martin Bailey and Doug Elliott for organizing this event. And for inviting me to join you. And Martin, thank you for those kind words. I'm delighted that Martin and Doug persevered after this event was snowed out back in March.
Oh, it was March, was it?
It was March. I think it was March 4th, because the topic is clearly central to discussions about financial stability. I'll start by noting that the views I express here are solely my own and don't reflect those of the Department of the Treasury. Well, you framed the topic in the question, can the financial system promote growth and stability? My answer to that is a strong yes. But the answer depends on the resilience and proper governance of the financial system. As the financial crisis that we saw in 2007 through 2009 clearly demonstrated, when those critical ingredients are lacking, shocks can be highly disruptive to growth and stability. Thanks to strong intervention, the financial system and the economy have recovered, but challenges to build and assure resilience remain. To this audience, the proposition that growth depends on a strong and stable financial system may now seem obvious. Yet a decade ago, many of you would not have asked whether the financial system could promote growth and stability. The consensus was that monetary policy had achieved price stability, low and stable inflation, and by reducing the inflation risk premium, had unlocked the door to strong, sustainable economic growth. To be sure, nagging questions lingered about financial booms and bond market conundrums, but 20 years of the great moderation fed a lack of caution. In my remarks this morning, I'll try to look at these issues in greater detail and to answer three related questions. First, has the legacy of the crisis held back economic recovery? Second, are there trade-offs between stability and growth? And third, what have we done to assure financial stability? What is left to do, and what are the current threats? The short answers to those questions are yes, yes and no, a lot, and three that I'll highlight. In answering the last question, I will, of course, describe what we at the Office of Financial Research are doing to promote financial stability. Regarding the first question, the slow healing of the financial system and of its capacity to provide credit continues to be a headwind to growth. Well, this is not news. The crisis impaired the availability of credit by forcing financial firms, other businesses, and households to deleverage, that is, to reduce their debt. However, deleveraging also helped advance U.S. financial healing. As evidence, household debt and debt service ratios have declined to or below sustainable levels, and some forms of credit are now growing along with the economy. But healing is incomplete. Mortgage credit availability is still constrained, and that's a factor behind our subpar economic performance. And that's why central banks continue to deploy both conventional and unconventional monetary policies, and why real long-term interest rates are at such low levels. Are there trade-offs between stability and growth? In the short run, some of the efforts to increase resilience may require adjustments that could raise intermediation costs and hence be temporary headwinds to growth. But as we saw, sometimes those are compatible. In the spring and summer of 2009, the incentives of the stress tests and TARP repayment requirements enable banks to massively raise capital. That stabilized the system and enabled banks to resume lending to support the recovery. That there may be some short-run trade-offs should hardly be surprising, but I think the long-run gains will be significant. Analogously, between 1979 and 1982, achieving price stability incurred significant short-run economic costs. But there, too, the long-run gains were considerable. Yet concerns are arising that regulation may perversely be contributing to more permanent adjustments that could impair market functioning. For example, several developments since the financial crisis have altered trading liquidity in securities markets and the ways investors redeem holdings to get cash. Some of these developments are by design. Regulations imposing tighter restrictions on bank leverage have increased the cost of securities financing activities, even against low-risk securities such as treasuries, and have reduced incentives to maintain those activities and the portfolios behind them. Bank trading books require more capital, and the Volcker Rule requires banks and their affiliates to refrain from proprietary trading. However, regulations are far from the only factors at play. Some causes are cyclical, such as changes in the supply of and demand for collateral, and changes in risk preferences. Other causes appear to be structural, such as changes in the investor base, in securities markets, and in the development of new financial products. In addition, changes in market structure, such as the spread of high-frequency trading and algorithmic trading to fixed income markets, may be at work in the sharp movement in prices that we observe periodically. Some traditional indicators, such as bid-ask spreads, suggest that reasonable market liquidity persists, but others do raise concerns. Since the crisis, market liquidity has become more fragmented in a few markets, such as those for sovereign bonds in emerging markets and in U.S. corporate bonds. Signs of bifurcation or fragmentation include the concentration of dealer inventories in high-quality liquid assets, declines in trading turnover relative to market size, declines in the size of average trades, and increased settlement failures. Perhaps more importantly, liquidity appears to become increasingly brittle even in the world's largest bond markets. Although liquidity in these markets looks adequate during normal conditions, it seems to disappear abruptly during episodes of market stress, contributing to disorderly price changes. In some markets, these episodes are occurring with greater frequency. Examples include the mid-2013 sell-off in U.S. fixed income markets, the October 2014 dislocation in U.S. Treasuries and futures markets, and the sharp moves in euro area government bonds in early May of this year. None of these episodes disrupted U.S. financial stability, nor do we yet sufficiently understand their causes. But together they highlight a potential weakness in markets that could amplify the impact of financial shocks. Other financial authorities have also indicated their concerns. For example, SEC Commissioner Michael Pivovar recently noted, the growth of bond mutual funds and exchange-traded funds, or ETFs, in recent years means that these funds now hold a much higher fraction of the available stock of relatively less liquid assets than they did before the financial crisis. He noted that their growth highlights the potential for a forced sale in the underlying markets if some event were to trigger large volumes of redemptions. Research to identify causes is clearly a cottage industry. For example, in a recent OFR working paper, our researchers explored patterns that connect daily liquidity conditions across a broad range of financial markets to financial conditions in the aggregate, both in normal times and under stress. This basic research represents a potential framework for monitoring market liquidity to extract signals to warn of impending disruptions. What about long-term trade-offs between stability and growth? Once again, I think the benefits of stability for growth will far outweigh any costs. In fact, financial stability is essential for sustainable growth. To quote former Fed Chairman Bernanke, quote, even in, or perhaps especially in, stable and prosperous times, monetary policymakers and financial regulators should regard safeguarding financial stability to be of equal importance as, indeed, a necessary prerequisite for maintaining macroeconomic stability. Let me now move to my final questions and my final answers. As a reminder, the questions were, what have we done to assure financial stability, what is left to do, and what are current threats to it? My answers were a lot, and 3 I'll highlight. To elaborate on those answers, I want to provide some context. Out of the crisis came a widespread appreciation for a different approach to policymaking. Financial stability is now a widespread policy objective. Policy analysis is focused on assessing threats to financial stability, and policymakers are creating more tools to combat those threats, developing what we call the macroprudential toolkit. Macroprudential, as most of you know, is a fancy word that means we now look across the entire financial system, not just in individual institutions or markets, to assess and to mitigate threats to financial stability. The crisis also exposed the need to improve the quality and scope of financial data to monitor activity across the financial system. Before the crisis, the data available to measure financial activity and exposures were too aggregated, too limited in scope, too out of date, or otherwise incomplete. No wonder regulators and policymakers poorly understood the extent of leverage, liquidity, and maturity transformation, the growth of non-bank activity and exposures. The data failed to show them. As you know, the Dodd-Frank Act established the Financial Stability Oversight Council to develop and implement the toolkit and created the Office of Financial Research to fill the gaps in data and analysis. The Council is charged with assessing and monitoring threats to financial stability, developing remedies for those threats, and restoring market discipline by eliminating too big to fail. We at the OFR have a mission to help promote financial stability by collecting and improving the quality of financial data and developing tools to evaluate risks to the financial system. Simply put, our work supports economic growth by helping to strengthen the financial infrastructure that growth requires. Our new macroprudential toolkit needs to assess the fundamental sources of vulnerability, to be more forward-looking, and to test the resilience of the financial system to a wide range of events and incentives. Assuring financial stability is not about predicting, much less preventing the next financial crisis. Rather, the toolkit must be aimed at improving financial system resilience to withstand the next crisis and assure system functionality under stress. In the past 5 years, federal financial regulators have taken important steps to make the financial system more resilient. Since the crisis, officials have conceived and put in place banks' new capital requirements. Bank regulators also agreed on key components of liquidity regulation and minimum requirements for firms holding of liquid assets. In addition, 2 tools have dramatically changed the approach to increasing resilience. The first is stress testing, which helps calibrate resilience and thus capital requirements. And the second is a new regime to resolve large, complex, and troubled financial institutions in an orderly way. These are consequential achievements that have made the banking system stronger, but vulnerabilities are still present outside the banking perimeter and across the financial system. We need tools to address them, and to develop the tools, we need to analyze and measure the vulnerabilities. That's especially important as financial activity migrates to more opaque and potentially less resilient parts of the financial system. Here, too, there is progress. Work is ongoing to assess risks and aspects of so-called shadow banking and develop tools to limit them. For example, there's agreement that minimum floors on haircuts can strengthen secured short-term wholesale funding markets. New regulations are also in place to strengthen derivatives markets and to make them more transparent. Because these initiatives must cut across the financial system, Close collaboration among U.S. Financial regulators is critical for their success. And the Council and the OFR can each play important roles in such collaboration. Indeed, I would argue that the collaboration needs to be global, given that markets and institutions are themselves both global. In the past 5 years, we've improved our understanding of how the financial system functions and our ability to measure financial activity and spot vulnerabilities. But we need to do more to understand how the financial system fails to function under stress, to spot vulnerabilities in the shadows, and to gather and standardize the data needed for our critical analysis and policymakers' responses to identified threats. We know that financial innovation and the migration of financial activity create a moving target, so our goal to eliminate gaps in data and analysis will always elude us, but we'll continue to fill the most important ones. At the OFR, we're looking across the financial system to fill gaps in financial data and analysis. And I'll give you a few examples of our work. First are the data initiatives which distinguish us from other macroprudential authorities. We're filling gaps in bilateral repo data in collaboration with the Federal Reserve. This project promises to improve our measurement and understanding of a key short-term funding market. A repurchase agreement, or repo, as you know, is essentially a collateralized loan when one party sells the security to another with an agreement to repurchase it later at an agreed price. Of the $3.8 trillion estimated in funding that the U.S. market provides daily, about half are in bilateral transactions. But data on such repos are scant. Because the repo market remains vulnerable to runs and asset fire sales, obtaining more information about these transactions will fill an important data gap. The OFR is helping the Commodity Futures Trading Commission and other regulators improve data quality in registered swap data repositories. These repositories are designed to be high-quality, low-cost data collection points for the data that are critical to understand exposures and connections across the financial system. We and the CFTC are jointly working to enhance the quality, types, and formats of data collected. This work is inherently global, so we're each collaborating on it with our counterparts at the Bank of England and the European Central Bank. The OFR is improving the quality of financial data by developing and promoting the use of data standards. We've led the initiative among governments and private industry worldwide to establish the Global Legal Entity Identifier, or LEI, a standard that's like a barcode for precisely and uniquely identifying parties to financial transactions. If the LEI system had been in place in 2008, the industry, regulators, and policymakers would have been better able to trace the exposures and connections of Lehman Brothers and others across the financial system. The LEI initiative has become fully operational in just a few years, but ubiquity is required to realize its full benefits. So I and others have called for mandating its use for regulatory reporting. In our Research and Analysis Center, we're developing new tools to assess and monitor vulnerabilities. For example, our Financial Stability Monitor helps us assess risks in 5 functional areas: macroeconomic, market, credit, funding and liquidity, and contagion, instead of in institutions or in markets. By so doing, the monitor helps us look across the financial system and spot threats wherever they arise. We're developing tools to assess risk in each of these 5 categories. For example, we're using so-called agent-based models to assess contagion risks in financial networks. These models have been used to study the spread of epidemics and ways to mitigate them. Likewise, they hold great promise for understanding the dynamics of fire sales, the spillovers from the default of a major counterparty and central clearing counterparties, and other chains of complex events. We supplement our financial stability analysis of the OFR with market intelligence. In February, we launched a financial markets monitor that summarizes major developments and emerging trends in global capital markets. By making it public, we aim to increase transparency, to enhance the availability of financial information, and to facilitate timely reactions by private industry to emerging risks and thereby to diffuse them. Before I close this morning, I want to elaborate on the response to the final hard question that I posed at the beginning of my remarks. What are the current threats to financial stability? In our 2014 annual report that we published in December, we said that the U.S. financial system has continued to recover and strengthen. Compared with the period just before the financial crisis, threats to financial stability are moderate. But we noted that the relatively benign backdrop is no cause for complacency because several financial stability risks increased during the previous year. 6 months later, that's still true. My remarks today have touched on two of those risks. The first is vulnerabilities associated with market liquidity, and the second is migration of financial activities towards opaque and less resilient corners of the financial system. A third major risk is due to excessive risk-taking in some markets during the extended period of low interest rates and low volatility. None of these will surprise you. Someone asked me recently what risks keep me up at night. I worry most about the risks that I understand the least. What are our blind spots? Has the continuous evolution and innovation in the financial system caused a buildup of risks in a part of the system where we're not looking? It's the unknown risks that keep me up at night. To sum up, the legacy of the financial crisis lingers, and we're just emerging from its effects on economic performance. Growth and financial stability can not only coexist, in my view, but financial stability is a predicate for sustainable prosperity. We have done a lot to build a more resilient financial system, but we certainly have more to do. Assuring financial stability will always be an ongoing challenge. I want to thank you for your attention, and I'm happy to take some questions.
Why don't you come and sit here and we'll have a little fireside chat.
Sounds good. Where's the fire?
In our hearts. Well, I'm happy to see we pretty much have a full house now. We also have a number of people that will be watching on the web, so I think we have a, not surprisingly, a good audience to listen to you. Listen to you, Dick. Where shall I start? Okay. So is it your view that the regulatory framework that has been put in place is consistent with strong economic growth? We've only had, as I said, very slow economic growth so far. Would you say that's partly because of the recovery of the financial system, or at this point, do you think there may be anything that's actually holding back growth from the financial side?
Well, as I indicated, I think that we've had very slow growth, if any, in mortgage credit, and that's clearly a legacy of the financial crisis.
Do you think that's mostly because people can't get mortgages, or because people are less willing to invest in houses since they saw house prices fall?
I think it's a combination of factors.
Combination.
Yep. I think that clearly credit availability is more restrained. It's more restrained in appropriate ways, but the pendulum has swung in a direction that has limited the availability of mortgage credit. But I think also, as you point out, on the demand side, there are other factors involved, and I think people are hesitating to invest in houses and to take on mortgage finance.
The other area that's cited as being a potential source of slow growth is that there aren't a lot of startup companies. Small business has not led the way in the way it used to. Now, I think small business is recovering some, but that's been a very slow process. To what extent has the startup issue and the small business issue been related to financing? Or is it again because of lack of collateral or lack of demand?
You know, it's always hard to say what all the sources are. I think in this case, certainly during the crisis, the availability of credit to small businesses was constrained.
Yeah.
Now that the banking industry has the capacity to extend loans, lending is growing at a brisk pace. If you look at, we don't have great measures of small business credit, but all the measures that we have show that it is really starting to grow again. So that should not be a constraint. I think that constraints from elsewhere also have been prevalent. So industries that are related to housing, which has been growing slowly, are also not doing quite so well. And I think there's a caution out there that has limited growth.
Let me ask you a slightly broader question about the role of OFR. We do have the Federal Reserve, which has a group of people that are now looking at financial stability as well as the staff that obviously is concerned about monetary policy. We've got the FSOC. Tell us a bit about how you see the OFR, what it was originally intended to do, and the extent to which you've been able to do it. And I understand you've only had a few years to get this thing going. But to what extent do you see OFR as being the guy that's going to wave the warning flag? Are you just providing information to the FSOC? How do you give us your sense of what is the broad mandate of OFR, and how successful do you think you've been so far in achieving that?
Well, it's a big question, but
yes, I realize.
I'll say two things. One is, we have the luxury of not having to make policy. That gives us an objective position from which to collect the data, to do the analysis that we think needs doing, to fill in gaps where others either don't have the authority or where they haven't looked. So in looking across the whole financial system, we can play a useful role for the council, and I think we are playing that role, as I tried to indicate. Second, the council itself and we at the OFR are evolving. I think they're new institutions.
Yeah.
Their members obviously consist of institutions that have been around for quite some time. In the case of the OCC, more than 150 years.
Right.
In the case of the Federal Reserve, a full century, just celebrated a short while ago.
Right.
And getting all those institutions to work together, that's really the role of the council, and we help to also promote that by collaborating with other council member agencies and doing the things that we're doing. So I think we've made progress. We have a lot more to do. I'll mention that I think we have a lot more to do in thinking about better ways to share data, better ways to fill the gaps in data and analysis. I think those things are starting to happen, but we need to do more work to make them happen.
Are you satisfied with the access to data that you've had?
I think we've, since I came to Washington, I've learned that access to data is something that always involves the legal community, and appropriately so.
Yeah.
We can't share data that are sensitive in any way without having appropriate safeguards. The process takes a while. I'd like to see the process move more quickly. I think it is starting to move more quickly now that we are starting to get the hang of it, if you will. But I think we need to make a lot more progress on that front.
Okay, let me look at a different, and I'm going to ask the questions from the audience in just a minute, so please get your questions ready and make them questions and relatively short and hopefully to the point. Let me ask you a bit about failure resolution, because I know you worked at Morgan Stanley for many years, and you know what a complicated bank looks like. And there were perhaps some misapprehensions about how difficult or easy it would be to take down Lehman back in the crisis. Do you think we're sort of solving that problem of too big to fail? Do you think that it will be possible at some point to use the bankruptcy process to resolve large institutions? How do you see that failure resolution process playing out? And because that's obviously a big factor in financial stability if a company goes down and it creates a panic around it.
Well, making policy related to the resolution process is out of my lane.
Yes, I know.
But I will
but
say...
if you can comment on it.
I will say that I think that there has been progress, as I indicated. I think that the implementation of the policies that have been put in place obviously has yet to occur. But I think the regulators are working hard to try to make sure that they are taking steps to make that implementation work. There are big issues across borders because of different laws and different approaches to that. Again, people are making progress on that. So what I would say is that the framework is there. Actually implementing the framework requires more work.
Yep. Good answer. Under your constraints. You mentioned 3 risk areas: liquidity, movement of activities into what I'll call the shadow sector. You used a different name. and the excessive risk associated with having low interest rates and hence the sort of reach for yield. Let me start you at the bottom of that. The BIS, Bank for International Settlements, wrote a paper recently, fairly recently, suggesting that there might be excessive risks associated with keeping rates so low for so long. As you look at the financial sector, where would you look for those risks occurring? I don't think they're occurring in the regulated banks, but is it outside the banks, or where do you think that might be popping up? Where are you guys looking?
Yeah. We have to look everywhere, Martin. I think that's really the basic point of our analysis. So, we want to look at places where people wouldn't expect to look. Obviously, there is a lot of focus on risk-taking and risk management in banks and other financial institutions. And I think one of the great advances since the crisis is that risk management at financial institutions has been elevated to a level of importance that wasn't there previously. So that's a good thing. As we look across the financial system, however, we always want to look in places where activity might be going and where the risks might be appearing and might be transferred in a way that undermines financial stability. And so if we look, for example, at, we cited in our annual report 3 areas of where activity might be migrating outside the traditional venues. One is, looking at leverage lending. So there's been guidance from the regulators about leverage lending. 90% of the activity has been occurring over the past year outside the banking system. Now that's, nothing wrong with that. Our capital markets provide an extraordinarily important role in intermediating and in providing credit. The question is whether the risks are appropriately managed and whether investors and issuers take account of those risks. Those are the kinds of things that we're looking at.
Now, I've heard some people say that if something migrates into the shadow sector, say a hedge fund, and the hedge fund takes risks and then goes down, so what? We don't have to worry about that so much. So maybe it's a good idea that some of these risks get driven into the shadow sector. Do you share that, or do you think there's some risks to the system associated with institutions that are not part of the normal bank regulation structure?
Well, I'm glad you asked that because I think a lot of people are confused by what we mean by shadow banking. Shadow banking is credit intermediation that occurs with the creation of money-like liabilities, that is to say, by funding with short-term, usually wholesale funding, and where there is no backstop, but where there probably is the need for a backstop because, as I indicated in my remarks, some short-term funding markets are subject to runs and asset fire sales. So those are vulnerabilities. It doesn't mean that it's inappropriate to do that, but if we don't take account of those vulnerabilities and make that part of the system more resilient, then that's where the weakest link in the chain is going to be. So broadly, I would say absolutely nothing wrong with having a diverse financial system as long as that diversity goes along with resilience in each of its parts, because shadow banks and other kinds of institutions are going to be connected back to the banking system.
Right.
And it's that interconnectedness that we failed to take account of during the crisis that I think is still quite important.
All right, I'm hogging all the questions, so let me ask if there are questions from the audience. Could you make your questions short and to the point, everybody?
Yes, thank you, Larry Checco. In your opinion, do you think we need to be, as a society, more concerned about regulation or slow growth in terms of what can happen? Because, quite frankly, the banks continue to not be as responsible as they should be all the time. And I'd rather see slow growth than what happened in '08. We lost about a good portion of our middle class. Thank you.
I'm interested to your answer to this one.
You won't be surprised to learn that my answer is that we need both. We need resilience and we need to have sustainable growth. And I think the key to my remarks this morning is precisely that financial stability is a predicate for sustainable growth. What we learned during the crisis is that we had stronger growth than we have prior to the crisis than we have right now, but ultimately it proved not to be sustainable because people weren't cognizant of the risks that were being taken. So we need a resilient financial system, one that supports sustainable growth.
Next question, there's one there. Please identify yourself also.
Hello, John Heltman with American Banker. You mentioned that liquidity is a source of concern. I want to get an idea of how big of a source of concern it is for you, and without stating necessarily a policy preference, what would be the regulatory options available to address those concerns in a meaningful way?
I mentioned in my remarks that market liquidity or trading liquidity is a source of concern because it appears in some markets to have become more bifurcated, more fragmented, and that's something that in response to shocks we can see outsized price moves. We don't have all the answers for the causes of this decline in market liquidity. And I think until we do have a better grasp of what some of those causes are, it'd be untoward to try to suggest remedies. I think what I tried to point out in my remarks are that some of this is by design. In other words, we wanted to make sure that we had a certain amount of resilience in markets as well as in institutions, and some of the steps that were taken in response to the crisis did just that. The question is, what's the interaction of those things with other factors going on in the marketplace? I talked about algorithmic and high-frequency trading in fixed income markets as potentially a source. Frankly, we need to do a lot more work in understanding what those causes are and how they interact before anyone can meaningfully suggest the right policy response.
Well, let me press you a little, Dick. I mean, don't you think that the Volcker rule often gets blamed for this lack of liquidity because financial institutions don't want to hold an inventory as big an inventory of assets on their books because they may be violating the Volcker rule. So maybe that's a good thing, or is it a bad thing? But when you're saying we don't know why there's less liquidity, isn't that one of the reasons?
Well, as I said, Martin, by design, some of the things that were put in place have reduced trading liquidity in markets. But I think the structure of markets is something that has changed. And so we need to look deeply at the structure of markets to understand what's going on there before we pin the blame on any particular cause.
Okay, next question. There's one here, Doug. Doug Elliott from Brookings.
Thank you, Dick. I've been struggling to frame my question, but you've talked a lot about need for better data, which clearly there is a need for. There's also a need for better theory of finance because we don't have great and certainly not unified theories of how the financial system works. Can you talk a little bit about how the OFR tries to deal with that situation and how you deal with the theoretical gaps as you try to form some conclusions?
Thanks, Doug. I'll leave it up to the finance profession to come up with theories of finance. There are always going to be competing theories. I think as people who use analysis to try to understand where the vulnerabilities in the financial system are, I think we need to understand how the financial system functions better, not just theoretically, but as a practical matter. And so one of the things that we tried to do at the OFR is combine various groups to come together and discuss what's really going on. Practitioners in the marketplace who really understand how the business functions and how markets function. Thought leaders, whether they come from a place like Brookings or from academic institutions. Specialists in data and technology who understand how to satisfy the needs for data and technology. And policymakers who have had experience with dealing with financial crises and markets under stress. It's the combination of those three groups, I think, or four groups, that really helps us really arrive at practical answers to the kinds of questions that we're facing. That's something that we do in our advisory committee. A couple of the members of the committee are in this room, and we've certainly benefited from their wise counsel and hope to continue to do so.
Well, let me just press you on that for just a second. I mean, we know that there are some anomalies in the CAPM that don't seem to quite fit what people do.
Sure.
We know that Modigliani-Miller, even though it's basically a tautology, but it does not seem to represent the way equities and bonds are priced, and essentially the equity premium seems out of line with any reasonable model there. Those anomalies make it difficult, don't they? I mean, just on a practical level, to make policy when you don't quite know what the ground is that you're standing on.
Well, they do, but here's the basic point. The theory is always just going to be a simplification of reality. And typically the theory, in the past at least, hasn't focused on how markets and the system functions under stress. System focuses on equilibrium. We're interested in, and we traffic in, disequilibrium. We traffic in multiple equilibria. I think the profession has started to grapple with those issues. As a practical matter, we need to think about tools that we can develop in order to run ahead of that so we can understand better what's going on. I mentioned agent-based modeling.
Right.
If you talk to finance professionals, they will say, well, agent-based modeling is too heuristic for our taste. It's something that really, is not grounded sufficiently in theory. But it does a pretty good job of understanding how contagion can spread from one part of the financial system.
That's the thing you mentioned
another.
about, like epidemics, you can sort of see a spread of financial panic or of fire sales or something like that.
That's right. So we have a lot more to do to fill in the gaps in analysis, but you have to start filling it in by looking at real-world problems, and that's what we're about.
So maybe you'll be checking on MERS as your latest threat to financial stability. Sorry about that. Yes, question back there.
Thank you. Hung Tran from the IAF. Thank you, Dick, for your presentation. Several organizations, the most notable of which is BIS, has held the view that zero interest rate and plentiful of liquidity, while justifiable and necessary to support the economy after the crisis, probably have lasted for too long and themselves have become a risk to financial stability. One, do you share that view? And second, to what extent monetary policy should be or ought to be part of the assessment of risk to financial stability?
Thanks for your question, Hung. I think, it's always hard to judge. I have the luxury of not making policy. I think that, our job is to spot vulnerabilities in the financial system wherever they arise and to think about what the right tool for the job is in order to address those vulnerabilities. We need to have a macroprudential toolkit. Monetary policy is part of that toolkit, broadly conceived. But there are others that we're developing that are aimed at addressing those vulnerabilities, and I think that's really where the work needs to continue and to be done.
I'd like to thank Dick for his speech and for his frank and insightful answers to those questions. And it's difficult, I know from experience, if you're in the government, sometimes it's difficult to give those answers, but you've done just a terrific job, and I'd like to thank you very much.
Thanks a lot.